Everyone spent 2 years saying AI was going to kill Google search, and Google just reported the best quarter in company history.
Search grew 19%, cloud grew 63%, net income jumped 84%. The company that was supposed to be disrupted is now disrupting everyone else and racing to become the most valuable company on the planet. So the real question isn't whether Google survives AI, it's whether you can afford to bet against it.
The infrastructure layer pivot. Alphabet has fundamentally transformed into the dominant infrastructure layer of the modern internet, completely shedding its identity as just a search engine. This specific moment is completely different from anything in the company's past. They are reaching a massive scale and physical vertical integration that literally underpins the entire next generation of global computing. Sundar Pichai triggered a 10% single-day stock jump when he flat-out admitted, "We are compute-constrained in the near term. Our cloud revenue would have been higher if we were able to meet the demand." You have a company growing at 63% standing up and saying they could have grown even faster if they just had the servers. And they absolutely mean it. That explosive demand drives the financials and CapEx math defining our Q1 2026 reality. Top-line revenues surged by 22%, but look at the huge disconnect between the 5.11 headline earnings per share and the 2.62 adjusted figure. That massive gap comes from a $37.7 billion mark-to-market gain on their Anthropic and SpaceX stakes. Strip that paper gain away, and the real operational story is those exploding cloud margins, jumping from 17.8% a year ago to 32.9% today. To get that margin expansion, the cost is brutal, $190 billion. That is the capital expenditure guidance for 2026 alone. We're looking at literal nation-state levels of spending compressed onto a short timeline. They spent $52.5 billion in 2024, $91.4 billion in 2025, and now they're guiding for $190 billion, with management stating 2027 climbs even higher. The brutal math to justify this $190 billion annual spend means their cloud segment, currently on an $80 billion run rate, must hold growth above 40% while those profit margins simultaneously expand. The constraint clearly isn't customer demand. Their total backlog just doubled from $240 billion to $462 billion in a single quarter. That proves the only real bottleneck is laying down physical servers fast enough to absorb the contracts they're already signing. Yet the broader market is completely mispricing this shift, which creates some wildly unmodeled TPU price action. The stock is sitting at $399, up from its 52-week low of $149. Even after climbing from its lows, trading at a 30x price-to-earnings multiple makes this the absolute cheapest mega-cap AI name on the market. Analyst targets currently range from $410 to $515. That street-high $515 target from Citizens JMP relies on a massive catalyst: Google selling custom TPU chips directly to enterprise customers. That is an entirely new revenue stream competing directly with Nvidia, completely unmodeled by the broader market. The reason they are capturing this market comes down to the enterprise AI angle and a fundamental difference in underlying architecture. Gemini is built as native infrastructure inside Google Cloud Platform, not a bolt-on layer like Microsoft's OpenAI integration. That structural difference shows up directly in the numbers, with Google Cloud growing at 63%, vastly outperforming AWS at 28%, and Azure at 40% in the exact same macro environment. These aren't experimental pilots. We're looking at massive, committed production workloads. Anthropic committed $200 billion over 5 years, joining Tier 1 enterprises like American Express, Merck, Klarna, and Figma. Direct TPU sales mean Google isn't just consuming the AI hardware market anymore, they are actively starting to compete in it. All of this data forces us to weigh the ultimate bull and bear cases. The aggressive upside is clear. Compute-constrained demand means this blistering 63% growth rate is actually the floor, not the ceiling. That massive backlog equals the strongest forward visibility in company history. Combine that with unmodeled hardware sales and core search growing at 19%, and the entire disruption narrative has been destroyed. At 30x earnings with 22% revenue growth, this is the cheapest of the mega-cap AI names. But there is a very dark side to this ledger. John Walker, president of Global Affairs, just sold 78% of his direct position in 90 days. That's $14.3 million in stock heading right out the door exactly as the company embarks on an unprecedented debt-funded CapEx cycle. This insider dumping pairs with a looming regulatory nightmare. The Department of Justice's search appeal threatens to strip their default placement deals, meaning they could lose prime real estate on billions of Apple and Samsung devices overnight. Add to that the European Union's Digital Markets Act violations, carrying the devastating risk of global fines up to 10% of total revenue annually.
The weight of this strategy is absolute. Funding $190 billion in capital expenditures requires years of flawless execution with zero room for error. One single demand slowdown turns that vast infrastructure build from an unassailable moat into the most expensive mistake in tech history. That heavy reality lingers directly over the key metrics to watch in the coming quarters. Holding Q2 cloud growth above 50% accelerates the entire bull case. Seeing direct TPU sales appear as a separate revenue line in Q3 makes that $515 target look conservative. If the DOJ forces structural search remedies, we have to reassess the entire valuation. And if 2027 CapEx exceeds $200 billion, the market will permanently decide whether this is pure genius or total recklessness. The company written off as an AI casualty is now the most aggressive AI infrastructure spender on the planet. Is Alphabet building an unassailable infrastructure moat or executing the most expensive miscalculation in the history of Silicon Valley?
If you found this explainer valuable, please hit the like button to help spread the word. Make sure you subscribe so we can keep decoding these massive industry shifts together.